Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. Well, there's been some intense moments over the last week or two, but things are certainly feeling a little bit quiet from yesterday's trading and going into today. Yet the underlying fundamental pressures continue to persist. We saw a host of data yesterday from Singapore manufacturing not looking so great to UK retail trade contracting again for the second month, to in Germany we saw the business climate index there fall away, and it's already in those previous lockdown levels and at previous GFC levels, and it's falling away again after trying to bounce. So that's a real concern. It kind of suggests that people got hopeful, but now they're giving up a little bit. So that's not a good outlook for the European economy. And of course, winter's not far away. And again, we will have a rerun of the concerns about energy supply during winter in Europe. Last winter was very mild, but this winter could be a lot steeper or harder. So what we're already noticing is that, in case you hadn't noticed, US natural gas prices are now up 20% from their lows. And that's because Germany and Europe have again intimated that they will be having a very strong demand for US natural gas supplies, and this will of course also impact the Australian market when Australian electricity prices here perhaps as well. But the impact on the US market is very strong because remember, the US lobbied long and hard for many years to get a bigger part of the European natural gas market. It certainly has that now, but the problem for the United States is, of course, it drives prices higher in the US. So I'd suggest that this move up, and there was a significant move on the day, but markets being more than 20% higher from their lows, is something to take notice of in the US, is that this is the beginnings of the anticipation of strong demand from Europe. Also, of course, on the economic data front yesterday, we had that terrible US Dallas Fed manufacturing index. I mean, that looks like a depression in the Dallas Fed region manufacturing sector, not a recession. It's very, very starkly negative there and has been for quite some time. And we know that across the United States, manufacturing is in contraction, in recession, and services are beginning to soften as well. And then we've got the banking crisis, which everyone sort of thinks, why are you still talking about that, Clifford? It's gone. No, it's not. It's simmering away. But also we have the coming commercial property crisis in the United States. You will have begun to see some of the stories about empty skyscrapers and so forth, and some owners actually walking away from the buildings as they can't get refinancing without having the tenants in those buildings. So some very difficult and challenging things happening still in the United States. Markets, the psychology of markets at the moment, well, I kind of saw that recent downturn coming, but now we're consolidating that sort of pullback from the highs, that period of buyer exhaustion, if you like, that period where markets began to recognize that yes, the Fed is being true to its word and interest rates could be continuing to go higher for longer, and that inflation is still very, very challenging. So that all those factors, including the buyer exhaustion, combined to get this recent down move in equity markets. And now we're consolidating, but with a very heavy tone. In Wall Street yesterday, we were testing the downside again. There is the chance here for a bit of an equity market bounce, but I have a feeling, as I suggested the other day, that there are now rather significant large money managers, hedge funds, etc. around the world who are feeling a little bit like, well, that could have been the top, and the US economy and the global economy are most definitely slowing again. So we might use any rally to lighten our investment load, because in that 8 to 9 week run up in the US equity market, pretty much everyone who wanted to buy stocks had done so. And that does leave the market exposed to a downshift at some point in time. So a little bit equally balanced, sitting on the fence here after the initial pullback in equity markets. Is it going to be a sustained down move for equity markets, or is it just another pullback, another buying opportunity, as so many in the money management industry would want to believe? So I'm cautious a little bit here too on the short term, but I do think that long-term backdrop of deteriorating global and US economic fundamentals is still in play, and therefore you have to wonder if US valuations should be at about their average historic levels, or should they be at the lower end of the range of their historic PE ratio valuations. Thanks very much. I guess my view is it's going to try and rally, but the rally won't work. But for the moment, I'm just going to see how that attempt at a rally pans out. I hope that helps. Clifford Bennett, Chief Economist, ACY Securities.